John A.G. here with a quick note before we start. Because imitation channels are copying this format, thumbnails, tone, and style to sell courses and memberships. Those channels use similar visuals and messaging to push signal groups and paid communities. But that is not this channel and never will be. This channel sells nothing, has never sold anything, and will never sell anything, because information should remain transparent, verifiable, and free from hidden incentives or agendas. What you receive here is raw data, primary sources, and analysis you can verify yourself, ensuring your decisions rely on evidence rather than persuasion or marketing tactics. If you are paying attention, drop Currency Archive in the comments so I know real viewers are engaging rather than bots scraping content automatically. You can also drop any question you want analyzed, because I read everything, including comments and messages, prioritizing topics that matter most to this community. Now, Tuesday evening, February 24th, 2026. Now, what happened today in the silver market is something I have never witnessed in over a decade. I do not say that for clicks or dramatic effect. I say it because the data supports it, and the implications are structurally significant. We now have two completely different silver prices operating simultaneously on this planet, one in Shanghai and another in New York markets today. The gap between those prices is so large and structurally significant that it signals something profound about the future of this market structure. Mainstream financial press either cannot understand this divergence or will not explain it, which is precisely why independent analysis is necessary right now. Let me walk you through exactly what happened, because the sequence of events matters more than any single headline number you might see. Silver spot in Western markets opened today around $88 per troy ounce, trading calmly between roughly $80, $465, and $88. By recent standards, that was a relatively quiet session, down about 1% from Monday's close. Nothing dramatic enough to trigger mainstream financial alerts. But while Western traders watched the $88 level, something entirely different was happening 9,000 kilometers away in Shanghai's reopened futures exchange. The Shanghai Futures Exchange reopened after a 9-day Lunar New Year closure, the longest annual pause for the world's largest physical commodity exchange. When trading resumed, silver did not open near Western prices, instead surging to 22,634 yuan per kilogram immediately. Converted to troy ounces using current exchange rates, that equals roughly $102 per ounce, far above the $88 New York price. That represents roughly a 16% premium on the same metal, on the same day, on the same planet, under two separate market structures. If you hold physical silver in Shanghai, the market values your metal above $100, while New York futures price paper claims near $88. That $14 gap is not a rounding error or temporary liquidity blip. It is a structural dislocation revealing stress in physical silver supply chains. Shanghai's premium is not new. Before the holiday, it already exceeded 11%, confirming a persistent divergence rather than a single reopening anomaly. Physical buyback prices in Shenzhen reached roughly $95 per ounce before reopening, showing local demand consistently values metal above Western paper prices. Over the past 6 months, the average Shanghai premium was 6.59%, peaking at 34% during January's dramatic crash. Gold's Shanghai premium currently sits near 0.29%, meaning silver's premium is roughly 38 times larger than gold's premium. That tells you something specific. This is not a broad precious metals dislocation, but a silver-specific physical supply crisis unfolding in real time. Why does Shanghai price silver higher than New York? 3 structural forces explain this divergence clearly when examined through policy, demand, and capital controls. First, China reclassified silver as a strategic material on January 1st, 2026, imposing strict export licensing, limiting approved exporters significantly. Only 44 companies received export approval, each required to demonstrate minimum annual capacity of 80 tons, restricting refined silver available to global markets. China controls roughly 65% of global silver refining capacity, so restricting exports creates a structural bottleneck no paper market can arbitrage away. Second, China's domestic demand is enormous and growing through solar panels, electronics, and electric vehicles requiring silver as an essential industrial input. China is both the largest solar panel producer and largest silver consumer, prioritizing domestic needs and signaling global markets must compete for remaining supply. Third, capital controls, import quotas, and a 13% value added tax create friction, preventing efficient arbitrage between Shanghai and Western markets. After accounting for VAT, the effective premium during January's crash reached 45.8%, representing an arbitrage opportunity blocked by regulations and logistics. This morning, Shanghai Futures Exchange Notice Number 46 announced suspension of additional accounts for violating abnormal trading behavior rules related to silver contracts. These accounts exceeded intraday position limits, triggering restricted opening measures, representing the latest escalation in enforcement actions building throughout the entire month. Earlier notices suspended multiple groups for similar violations, totaling dozens of clients restricted, highlighting intensified oversight of aggressive short positioning within Chinese markets. In January alone, the exchange processed 125 abnormal trading cases, including dozens of intraday exceedances and coordinated account activity investigations. Approximately 23 accounts have been suspended or restricted in February, reflecting a pattern of regulatory tightening during rising silver price volatility. Reports circulating online claim some accounts linked to Western banks, including allegations involving JP Morgan, though exchange notices do not disclose specific identities. Disruption Banking reported JP Morgan allegedly closed a massive short position at the intraday bottom of the largest silver crash in decades. COMEX delivery data shows JP Morgan involved in February deliveries totaling hundreds of contracts, a pattern some analysts consider suggestive but not conclusive. What remains undisputed is enforcement intensity. The exchange lowered intraday limits to 800 lots, making violations easier to trigger intentionally. The message is clear. Manipulative selling activity will be identified and terminated, whether domestic or foreign participants attempt to distort Chinese silver markets. Now connect this to developments on COMEX, where a parallel crisis is unfolding as registered inventories continue collapsing amid accelerating physical withdrawals. Registered silver fell to roughly 88 million ounces by February 22nd, a 47% decline from October 2025 inventory levels. In 4 months, nearly half of deliverable silver disappeared from vaults, with weekly outflows exceeding 14 million ounces during mid-February alone. Trailing 30-day net outflows exceed 54 million ounces, highlighting accelerating physical demand, removing metal from exchange inventories at unprecedented rates. Major vault operators reported daily losses, while eligible inventories remain inaccessible because ownership rights prevent forced conversion into deliverable registered supply categories. March represents the most active delivery month, with open interest representing roughly 220 million ounces, about 2.5 times registered supply. Coverage ratios now indicate stress conditions, with multiple claimants per registered ounce creating a potential mismatch if significant contract holders demand delivery. First notice day is February 27th, when remaining long holders may demand physical delivery, exposing whether inventories can satisfy contractual obligations. Even partial delivery demands could overwhelm supply, forcing cash settlements, emergency sourcing, or rule modifications to maintain exchange functionality under extreme stress. February deliveries already reached unprecedented levels for a minor month, while January deliveries exceeded prior years by multiples, signaling urgent demand for physical metal. Backward rolling patterns showed traders shifting positions into near months for immediate delivery, indicating participants want metal now rather than future settlement promises. Important caveat: eligible metal can convert to registered within 48 hours, and exchanges can modify rules, reducing default probability despite headline inventory constraints. The system has shock absorbers, and analysts estimate default probability near zero, yet repeated stress responses erode confidence in paper market delivery reliability. Options. Markets reveal extreme tension. Implied volatility exceeds 100% annualized, while realized volatility remains far lower, signaling expectations of violent resolution. Implied daily moves suggest potential 20% swings, yet spot prices remain range-bound, indicating options. Traders anticipate sudden breakout from current calm conditions. Exchange for physical spreads widened dramatically, lease rates spiked, and margin requirements rose to levels seen only during historic silver crises decades ago. Every plumbing indicator in the silver market is flashing red simultaneously, reflecting systemic strain from sustained deficits, rising demand, and tightening global supply chains. Gold context matters. Gold trades near record highs while the gold-silver ratio compresses, historically signaling silver outperformance during acceleration phases of bull markets. Macro conditions align with metal strength, including tariff disputes, dollar weakness, geopolitical tensions, and stagflationary signals combining slow growth with persistent inflation pressures. Major banks publish bullish targets for gold and silver, indicating institutional recognition of structural shifts supporting higher precious metals valuations over coming years. Mining companies report record revenues and margins, producing silver far below market prices, yet analyst models still assume outdated price ranges for valuation purposes. When models update to reflect current prices, mining equities could reprice violently, revealing disconnect between operational reality and conservative institutional forecasting assumptions. SLV experienced net outflows despite rising prices, suggesting institutional profit-taking, while retail demand pushed premiums above net asset value for physical exposure. PSLV expanded equity programs, signaling confidence in sustained demand for physically backed silver, contrasting with institutional caution observed in exchange-traded fund flows. Now, the bear case. Shanghai's reopening created catch-up pricing after closure, and premiums may compress as markets resynchronize over coming trading sessions. COMEX stress has resolved before through cash settlement and emergency sourcing, proving the system's resilience despite repeated inventory shortages and delivery mismatches historically. Implied volatility cuts both directions. Silver can fall as violently as it rises, as demonstrated by January's 40% collapse within 30 hours. Industrial demand drives over half of silver consumption and remains vulnerable to recession, which could reduce solar, electronics, and vehicle production temporarily. Analyst targets vary widely and may take years to materialize, reminding investors that direction and timing are separate skills requiring disciplined risk management. These risks deserve equal consideration alongside bullish arguments, because anyone claiming silver only rises is selling something, which this channel refuses to do. Taken together, we are witnessing two separate silver markets. Shanghai pricing physical above 100, while New York prices paper claims near 88. Exchange enforcement actions, collapsing inventories, extreme options pricing, and record mining profits all signal structural transformation rather than temporary volatility in precious metals markets. The monetary regime shift is current reality, with declining dollar dominance, rising central bank gold reserves, and alternative settlement systems emerging across global trade networks. All data cited is public, verifiable, and accessible, reinforcing that what we are witnessing is not noise, but a structural signal within global commodity markets. Verify everything presented, check sources, and understand the next 72 hours into first notice. Day may determine paper silver market credibility going forward. The answer will come from market behavior, not commentary. So invest with logic, manage risk carefully, and avoid hype-driven decisions in volatile environments.